Most people think banks lend out money that already exists. That's wrong. Banks don't just move money, they create it. And once you understand how that works, a lot of things that never made sense before suddenly snap into focus. Why debt keeps growing, why inflation feels permanent, why housing prices explode, and why the system always seems to favor people who already have assets. Today, I'm going to show you how banks create money, where that money actually comes from, and why this system quietly reshapes your life, whether you participate in it or not. No jargon, no conspiracy theories, just the math. Most people believe that when you deposit money into a bank, the bank keeps it safe and then lends some of that money to someone else. That sounds reasonable. It also sounds logical, and it's completely wrong. In reality, banks do not lend out deposits. They lend first, and deposits appear after. This isn't speculation. This comes directly from central banks themselves. When a bank issues a loan, it does not transfer existing money from one account to another. It creates new money by typing numbers into existence. Yes, literally. Let's walk through what actually happens when you take out a loan. You walk into a bank and get approved for a $300,000 mortgage. You probably think the bank takes money from savers and gives it to you. What really happens is this. The bank creates a new loan asset on its balance sheet for $300,000. At the exact same time, it creates a matching deposit in your account for $300,000. No one else's account goes down. No vault gets emptied. No pile of cash moves. The money is created out of nothing. This is why modern money is described as credit-based money. Loans create deposits. Deposits do not create loans. That single sentence explains almost everything. So, how is this even allowed? Because banks don't operate like normal businesses. They operate under fractional reserve banking combined with capital requirements. Banks are not constrained by how much money they have. They are constrained by how much capital they hold relative to risk. If a bank meets its regulatory capital ratios, it can create new loans, and every loan creates new money. This means the total money supply expands when credit expands and contracts when credit contracts. That's why recessions feel violent. It's not just spending slowing down, it's money literally disappearing as loans are paid off or defaulted. Now here's the part most people never think through. When a bank creates a loan, it creates the principal. It does not create the interest. So where does the interest come from? From more lending. That means the system mathematically requires continuous expansion of credit just to remain stable. If credit stops growing, someone somewhere cannot pay what they owe. That's not ideology. That's arithmetic. This is why governments carry permanent debt, why households feel pressure to borrow, why asset prices inflate over time, and why economic growth always seems to require more leverage. The system doesn't just encourage borrowing, it depends on it. Now let's talk about who benefits. When banks create money, where does that money go first? Not to wages, not to savings accounts, not to everyday spending. It goes to assets. Mortgages inflate home prices. Business loans inflate equity values. Financial leverage inflates stock markets. If you own assets, newly created money flows toward you. If you rely on wages, it reaches you last, after prices have already risen. That's why inflation feels invisible to people at the top and brutal to people at the bottom. Inflation is often explained as too much money chasing too few goods. That's true, but incomplete. What matters is where the money enters the system. When money is created through bank lending, it inflates the things lending is used for. That's why housing inflates faster than wages, education costs explode, healthcare becomes unaffordable, and financial assets detach from reality. This also explains why saving feels harder every year. Your savings are static, the money supply is dynamic. While you're saving dollars, the system is creating more dollars, mostly tied to debt and assets. If your savings don't earn returns that keep up with asset inflation, you fall behind even while doing everything right. That's why cash feels safe but quietly loses power, and why people feel forced into risk just to stand still. Now let's talk about crashes. When loans default, money is destroyed. Loans create money. Repayment destroys it. If defaults spike, deposits disappear, balance sheets shrink, liquidity vanishes. This is why central banks step in during crises. Whether you agree with it or not, that's the mechanism. From the outside, this system feels rigged, and in some ways it is, not by malice, by structure. If you don't own assets, don't have access to cheap credit, and don't benefit from early money creation, then you experience inflation as punishment rather than growth. Once you understand how banks create money, a few things change immediately. You stop thinking in dollars. You start thinking in position. You stop blaming yourself for systemic math and start making strategic decisions instead of emotional ones. That's the real value of understanding this system, not outrage, clarity,